They told you there's one price for silver. They told you the market is efficient. They told you price discovery happens in an orderly way, that buyers and sellers meet and agree on a fair value. And that's the price everyone pays. But what if I told you that right now, at this exact moment, silver is trading at two completely different prices on two different sides of the world? What if I told you the gap between those prices is over 40%? And what if I told you that understanding why this gap exists might be the most important thing you learn about precious metals this year? Because here's the reality that most people don't want to acknowledge. In New York on the COMEX exchange, silver is trading around $92 per ounce. In Shanghai, that same silver, the exact same metal, is trading around $130 per ounce. Same element, same atomic number, same physical properties, 40% price difference. That's not a rounding error, that's not a minor discrepancy. That's a chasm so wide you could drive a truck through it. And the fact that this gap exists tells you something profound about how these markets actually work, what price discovery really means, and where the true stress points in the global silver market are hiding. Quick favor before we dive into this, I'm building something real here at Financial Crux, and stories like this are exactly why independent analysis matters. The mainstream financial media isn't going to connect these dots for you. They're not going to explain why two markets for the same commodity can show radically different prices. If you find value in what we do, support the mission by subscribing and dropping a comment below. And if you want the real-time updates on developments like this, join the WhatsApp community and follow us on X. Links are in the description. Now let's get into it. I want to start by explaining how the COMEX market actually works, because most people have no idea. They think they understand it. They think futures trading is just betting on where prices go. But the reality is far more interesting and far more consequential for anyone who owns or wants to own silver. The COMEX, which stands for Commodity Exchange, is the primary exchange in the United States for trading precious metals futures. When you see the silver price quoted in financial news, when you check the spot price on your favorite website, when analysts talk about where silver is trading, they're almost always referencing COMEX pricing. It's the benchmark. It's the number everyone uses. But here's what most people don't understand. The COMEX is primarily a paper market. The vast majority of contracts traded on the exchange are settled financially, not physically. Traders buy and sell futures contracts that represent silver, but they almost never take delivery of actual metal. They close out their positions before expiration, pocketing gains or absorbing losses, and then move on to the next trade. This creates a market where the connection between price and physical availability becomes tenuous at best. You can have a situation where the price on COMEX is falling, even as physical silver becomes harder to find. You can have a situation where massive selling pressure drives prices down, even though there's been no change whatsoever in the actual supply of metal. And here's the number that should make you sit up and pay attention. According to market data and industry estimates, there are more than 300 paper ounces of silver represented by futures contracts for every single physical ounce available for delivery. 300 to 1. That's not a market, that's a leverage game. That's a structure where the vast majority of participants have no intention of ever touching real metal, where price discovery happens in a world of electronic contracts rather than physical supply and demand. Now, does this mean the COMEX price is fake? Not exactly. It means the COMEX price reflects the dynamics of the futures market, which are dominated by financial flows, positioning, liquidity, and the strategies of large institutional traders. When a major bank needs to hedge its exposure, it trades on COMEX. When a hedge fund wants to make a leverage bet on metals, it trades on COMEX. When systematic algorithms are rebalancing portfolios, they trade on COMEX. All of that activity influences price. But none of it necessarily reflects what's happening with actual physical silver. The supply in warehouses, the demand from industrial users, the purchases by retail investors stacking coins. All of that exists in a parallel universe from the COMEX price, intersecting occasionally, but often diverging for extended periods. Now let me tell you about Shanghai, because this is where the story gets really interesting. The Shanghai market operates on completely different principles. When someone buys silver in Shanghai, they typically take delivery. The contracts are settled with actual metal, not cash. The price reflects what buyers are willing to pay to secure physical supply right now, not what speculators think the price should be in 3 months. This creates a market that responds directly to inventory levels, transportation logistics, and immediate demand. When industrial buyers in China need silver for solar panels or electronics, they buy it in Shanghai. When refiners bring metal into the market, it gets sold in Shanghai. The price moves based on real supply meeting real demand. And right now, that price is around $130 per ounce, 40% higher than COMEX. Think about what that means. Chinese buyers who need actual silver for actual manufacturing are paying 40% more than the benchmark price that everyone in the West uses. They're not doing that because they're stupid. They're not doing that because they enjoy overpaying. They're doing that because when you actually need to get your hands on physical metal, the COMEX price is irrelevant. What matters is what it costs to secure supply. Some analysts have noted that Shanghai metal market assessments have remained above $120 consistently. Premiums rise when supply tightens, when delivery speed matters, when buyers are competing for limited availability. That's exactly what we're seeing. The Shanghai price is telling you something that the COMEX price is obscuring. Physical silver is scarce. Physical silver is in demand. And people who actually need it are paying significantly more than the paper benchmark suggests they should. Now here's where I need to address the obvious question. Why doesn't arbitrage close this gap? In a perfectly efficient market, traders would buy silver at the lower price in New York, ship it to Shanghai, and sell it at the higher price, pocketing the difference. That arbitrage activity would continue until the prices converged. That's how markets are supposed to work in the textbooks. But we don't live in a textbook. We live in a world with capital controls, export restrictions, transportation bottlenecks, and regulatory barriers. China has restrictions on metal flows that prevent unlimited arbitrage. Getting silver into China isn't as simple as loading a ship and sending it over. There are quotas, there are approvals, there are complications that prevent the free flow of metal that would otherwise close the gap. And even beyond the regulatory barriers, there's a more fundamental issue. Most of the silver that trades on COMEX isn't available for delivery in the first place. Remember that 300-to-1 ratio. The vast majority of COMEX contracts are never going to result in physical delivery. So even if someone wanted to buy on COMEX and deliver to Shanghai, the metal might not actually be there to take. This is the structural reality that most market commentary ignores. The COMEX price is a benchmark for a paper market. The Shanghai price is a price for actual metal. And when physical demand is strong enough, when supply chains are constrained enough, those two prices can diverge dramatically. The 40% gap we're seeing right now is not an anomaly. It's a signal. It's the market telling you that something fundamental is happening in the relationship between paper claims and physical reality. Now let me tell you about what's been happening in China over the past few weeks because it adds another layer to this story. Chinese regulators have been forced to intervene in commodity markets in ways that are genuinely extraordinary. They've suspended trading on multiple commodity funds, including China's only public fund that invests in silver futures. And they've done it not once, but multiple times. The UBS SDIC Silver Futures Fund, which is the only public fund in mainland China that directly invests in silver futures, has been suspended for full trading days twice since January 22nd. This isn't a technical glitch. This isn't a routine maintenance pause. This is emergency intervention designed to stop what regulators called unsustainable speculation. At its peak, the fund was trading at a 36% premium over the Shanghai futures exchange silver contracts it was supposed to track. That means Chinese investors were so desperate to get silver exposure that they were paying 36% more than the underlying asset was worth. They were paying a premium on top of prices that were already 40% higher than COMEX. The demand was that intense. Regulators saw exactly where this was heading. If that premium collapsed, if conditions reversed, investors who bought at those elevated prices would face catastrophic losses. So they stepped in. They halted trading. They forced a cooling off period. They essentially said no more until the mania subsides. But here's the thing about forced halts. They don't change the underlying demand. They don't change the supply situation. They don't change the fact that Chinese investors, for whatever combination of reasons, desperately want silver exposure and have limited options to get it. The demand that created those premiums didn't disappear when trading was suspended. It just got bottled up, waiting, building pressure, looking for alternative outlets. And this is happening at the same time that the 40% gap between Shanghai and COMEX persists. At the same time that physical premiums remain elevated worldwide, At the same time that industrial demand for silver in solar panels, electric vehicles, and electronics continues to grow, the system is under stress. And the trading halts in China are a symptom of that stress, not a cure for it. Now, I want to explain why Krupp's projection matters in this context because it adds credibility to the idea that the current situation is not sustainable. Citigroup, one of the largest banks in the world, has projected that silver could reach $150 per ounce within 3 months. That's not a random number from some guy on the internet. That's a major institutional bank putting their analytical reputation behind a very specific, very aggressive price target. Their reasoning is straightforward. They noted that Chinese retail investors tend to be trend following. When prices rise, they buy. When momentum is strong, they pile in. And that behavior creates self-reinforcing rallies that can push prices far beyond what fundamentals might suggest. But here's the interesting part. The $150 target that Krupp is projecting for COMEX pricing is actually below where Shanghai is already trading when you factor in the premiums. In other words, Krupp is essentially saying that the paper market will have to catch up to where the physical market already is. That framing changes how you think about the current gap. It's not that Shanghai is overpriced, it's that COMEX is underpriced. It's not that Chinese buyers are irrational, it's that the paper benchmark is disconnected from physical reality. And at some point that disconnect has to resolve. Either physical prices will crash to meet the paper benchmark, or paper prices will rise to meet physical reality. Those are the only two options. And given everything we know about supply constraints, industrial demand, and the intensity of physical buying, which direction do you think is more likely? Now let me address something that I know is on many people's minds. If this gap is so obvious, if the opportunity is so clear, why isn't everyone talking about it? Why isn't this front page news? The answer, as usual, comes down to incentives. The financial establishment has built its entire infrastructure around the COMEX benchmark. Banks use COMEX pricing for hedging. Miners use COMEX pricing for production decisions. ETFs are structured around COMEX. The entire paper-silver ecosystem depends on COMEX being accepted as the legitimate price. If you start questioning whether COMEX pricing actually reflects the value of silver, you start questioning the entire foundation of how these markets operate, and that's threatening to a lot of powerful interests. So instead, you get silence. You get commentary that focuses on COMEX prices as if they're the only prices that matter. You get analysis that ignores the Shanghai premium entirely. You get a narrative that says the paper market is efficient and the physical market is an irrelevant niche. But the 40% gap says otherwise. The trading halts in China say otherwise. The 300-to-1 paper-to-physical ratio says otherwise. The evidence is there if you're willing to see it. Let me talk about what this means for the future because that's ultimately what matters. There are 3 scenarios for how this plays out. Scenario 1 is that the gap persists indefinitely. Paper markets continue to function independently of physical reality. COMEX prices stay low while Shanghai prices stay high. Arbitrage remains constrained by regulations and logistics. The two-price system becomes a permanent feature of the silver market. This is possible, but it seems unstable. Markets that diverge this dramatically tend to find ways to converge eventually, even if it takes longer than anyone expects. Scenario 2 is that physical prices crash to meet the paper benchmark. Shanghai prices collapse. Chinese demand evaporates. The premium disappears and COMEX pricing is vindicated as the true value of silver. For this to happen, you would need Chinese industrial demand to fall dramatically. You would need the solar and electronic sectors to stop growing. You would need the investment demand that drove the premiums to reverse completely. Possible, but not consistent with the trajectory of Chinese manufacturing and green energy investment. Scenario 3 is that paper prices rise to meet physical reality. COMEX pricing catches up to what Shanghai has been signaling. The 40% gap closes not through Shanghai falling, but through New York rising. And everyone who was buying the paper benchmark realizes they were getting a discount that the physical market never actually offered. I can't tell you with certainty which scenario unfolds. Anyone who claims that certainty is selling you something. But I can tell you that the structural factors favor scenario 3. Industrial demand is growing, supply is constrained, central banks are accumulating, retail stackers are buying, and the paper market has a 300-to-1 ratio that cannot be sustained if even a fraction of those claims try to convert to physical delivery. Now, let me give you a framework for how to think about this situation practically, because understanding the theory is only useful if you can translate it into action. First, recognize that there are now effectively two silver markets. The paper market gives you one price, the physical market gives you another. Depending on how you're accessing silver, you might be participating in one or both. If you own silver ETFs, you're exposed to COMEX pricing. If you own futures contracts, you're exposed to COMEX pricing. If you own physical coins and bars, you're exposed to physical pricing, which includes premiums over spot that can be substantial during tight supply periods. Second, understand that the COMEX price is not necessarily the true price. It's a benchmark that serves certain functions for certain participants. But if you tried to buy large quantities of physical silver at COMEX spot prices, you would quickly discover that the real cost is higher. The gap between paper and physical is not just a Shanghai phenomenon. It exists everywhere. Shanghai is just making it visible in a way that's impossible to ignore. Third, consider what a convergence would mean for different types of silver exposure. If COMEX prices rise to meet Shanghai, paper silver investments would appreciate. If the gap closes through Shanghai falling, physical holders would see their premium evaporate. Your positioning matters. Fourth, pay attention to China. What happens in Chinese markets is increasingly relevant for global commodity pricing. The trading halts, the fund suspensions, the premiums, the intense retail demand. All of these are data points that tell you something about where the stress in the system is concentrated. When the largest manufacturing economy in the world is paying 40% more for silver than the benchmark suggests, that's not noise, that's signal. Let me address the skeptics for a moment, because I know some people watching this are thinking that I'm exaggerating the significance of this gap. You might say that Shanghai premiums have existed before and eventually normalized. That's true. Premiums ebb and flow based on supply and demand dynamics. But the current premium is at the extreme end of historical ranges, and it's persisting even as regulators actively intervene to suppress speculative demand. You might say that the paper market has functioned fine for decades despite the disconnection from physical. That's also true. The system has shown remarkable resilience, but resilience is not the same as invincibility. Systems can function with imbalances for long periods and then adjust suddenly when a tipping point is reached. You might say that anyone predicting a collapse in the paper market system has been wrong for years. That's fair. The silver manipulation thesis has been around for a long time, and the predicted reckoning has not arrived. I'm not predicting a collapse. I'm pointing to observable data about pricing gaps and asking what it means. The 40% gap is not a prediction. It's a fact. The trading halts are not speculation. They happened. The 300-to-1 ratio is not conspiracy. It's derived from published data. What you do with those facts is up to you. But pretending they don't exist doesn't make you sophisticated. It makes you uninformed. Now here's my question for you, and I genuinely want to see this discussion in the comments. Did you know about the Shanghai premium before watching this video? Does understanding the gap change how you think about silver pricing? And if you're positioned in silver, are you holding paper or physical? The answers to those questions matter more than any analysis I can provide. Drop your thoughts below. Share what you're seeing. Tell me what you're thinking. That kind of community discussion helps everyone understand the situation more completely. Before I wrap up, let me remind you that the links to the WhatsApp community and X are in the description. When stories like this are developing, real-time updates matter. The gap between Shanghai and COMEX changes. Regulatory interventions happen suddenly. Having access to quick analysis can help you stay informed as the situation evolves. Let me offer some final thoughts on what this story reveals about markets in general. We live in a world where most people accept the prices they're quoted without questioning how those prices are determined. They see a number on a screen and assume it reflects reality. They don't ask who is setting that price, through what mechanism, with what relationship to actual supply and demand. The silver market is a window into how that assumption can be wrong. It shows you that price discovery is not neutral. It shows you that different market structures produce different prices. It shows you that the benchmark everyone uses might not be the benchmark that reflects physical reality. That's not unique to silver. It applies to every market where derivatives and financial instruments have grown to dwarf the underlying physical assets. It applies to oil. It applies to agricultural commodities. It applies in various forms to almost every tradable asset. Understanding that the price you see is not necessarily the price that exists everywhere is a fundamental insight for navigating financial markets. It doesn't mean all prices are manipulated. It doesn't mean you can't trust any benchmark. It means you should understand what you're looking at and recognize its limitations. The 40% gap between Shanghai and COMEX is an extreme example of this principle. It's visible, it's quantifiable, it's undeniable. And if you can understand why it exists, you understand something important about how markets actually work. Silver is trading at two prices. One reflects paper claims, one reflects physical demand, and the gap between them is wider than it has been in recent memory. What happens next will tell us a lot about which market is telling the truth.